Hello there, Pursuing Freedom friends. Thanks as always for tuning in. If it's your first time here, welcome aboard, buckle up. And if you're a repeat offender, thanks for sticking around and coming back for more. I'm thrilled today to introduce you to my guest. And I'm kind of fangirling over here with Kathy Fettke because I read her #1 best-selling book, Retire Rich with Rentals, a couple years back. I think I had heard you, Kathy, on someone else's podcast. Maybe it was Bigger Pockets, but Kathy is a real estate investor. She's an author, she's a mentor and a coach and a speaker, and she's the #1 best-selling author of Retire Rich with Rentals, as well as the host of 2 podcasts, The Real Wealth Show, Real Estate News for Investors, and is a host as well of the Bigger Pockets show on Market. She's also a wife, a mom, an avid adventurer. So as you can imagine, if you've been following this podcast for a long time, I am feeling like I'm meeting a spirit animal that I'm so excited to share with the audience here. And she and her partner also have a national brokerage where they are researching the markets to best invest in the United States and are referring out business all over the country. So if you are a real estate agent listening, this is a great opportunity for you to connect with Kathy and be maybe on that list of receiving her referrals. So with no further ado, Kathy, I would love for you to just kind of share your backstory and how you got yourselves into real estate investing, but then more importantly, how you managed to stay with your finger on the pulse of what's going on in the national markets. And we'll dig our teeth into that a little bit as well.
Sure, yeah. It all started about 20 years ago when I was a stay-at-home mom. My husband Rich was had just come out with his book called Extreme Success, which was about achieving success in the same way that you do extreme sports. So kind of overcoming fear, basically. And he was doing great. He was traveling around the country. But while on his travels, he noticed a freckle, and that freckle happened to be melanoma when he came to check, to get it checked. And back then, this is 20 years ago, there was little chance of survival. Melanoma is a skin cancer. It's a fast moving one. He was a former bodybuilder, so he did a lot of tanning and tanning booths and whatever, and I remember saying, no, that's probably going to cause skin cancer. Anyway, it probably did. So at the time, this was 20 years ago, the doctor said he probably had 6 months to live. That was the survival rate of melanoma at the time. So we had 2 young children. I was living the dream. I still had a radio show on the weekends from my broadcast career prior to being a mom. And I had to just suddenly like figure it out. Like, first of all, I refused to believe the doctor and I thought Rich is going to be fine. But at the same time, there's always that chance that maybe the doctor was right. So I used my little Saturday radio show in San Francisco to just start interviewing people who had created wealth because it wasn't really something I knew how to do. I had been in broadcasting. I made a decent check before I became a stay-at-home mom, but we weren't independently wealthy by any means. We were saving 10% of our income for investments, 10% for emergencies, 10%, the little buckets. And you can run out of that pretty quickly when you have some kind of health emergency. So there we were trying to figure out what to do next. And I just kept interviewing wealthy people, and it really came down to 2 things. They either had made their money in business or in real estate, or both. Like, they would take their money from their business and invest it in real estate, or their real estate was a business. And that's how they created passive income. So I became obsessed with it.
And then how quickly did you activate on that obsession? And what did that look like? What was the trajectory? Because a lot can happen in 20 years, and a lot has happened in the real estate markets in 20 years. I mean,
Yeah.
what unfolded from there?
Well, I would say, well, the biggest thing that came next is kind of your background. I brought on a sponsor for the show because I needed money immediately. And a lot of people don't realize investing is different than making money. You can make money in real estate, that like from flipping or wholesaling or whatever, but investing in real estate is different. Than It's not active, it's passive. So I needed money, like, not to invest, but to live on. And so I brought on the sponsor, and it turned out, he was a mortgage broker. Mortgage brokers were making bank at the time. It was 2003, 2004. This is when, the middle of the mortgage boom, and you could make 3 points on one loan. So, a $1 million California refi was 30 grand, it was big, big bucks. So my sponsor was willing to write a big check to be the sponsor of my show. And I thought, nobody's going to care about rates or mortgages. This is boring. But we could probably bring the topic to life if we interviewed his clients and found out what they were doing with these loans. So that was kind of the direction I took that sponsorship, and just started interviewing his clients who were doing what I just said. They were either flipping homes, or they were living in a home for 2 years, fixing it up and then selling it to get that $500,000 tax free. Or they were buying rental properties or BRRRRs. It wasn't really called that back then, but where you buy, renovate, rent it out, and then refi it at the higher value and get all your money back out, go do it again. So my eyes got open to this whole new world of investment. And our phone started ringing off the hook with people who wanted to do what our guests were doing. And my sponsor said, I can't handle all this business. Why don't you become a mortgage broker and help me out? So the sponsorship worked, but at the same time, I got to learn one of the most powerful things of real estate investing, and that is the use of leverage. I got to learn it inside and out. As you know, that's the power.
Yeah, so you talked about a lot of things there, and I think back to when I fell into the business in the mortgage side, it was '06, and in '07 went 100% commission just in time for '08, '09. Felt like a real genius there. And one of my questions is, what strategies are you seeing in the current market that are different than what was effective back then? Because we as well just started kind of keeping every house we lived in, and we bought our first place when we were engaged, and it was Denver, and it was '08, and it was a foreclosure. And since we held on to that, that turned into, an opportunity for wealth building. And then we got the next one when our first child was a baby, and the next one we were expecting the next child. And then as a mortgage advisor, I just kept telling my clients about it. I was like, don't buy the thing you think you're going to live in for the next 25 years. Just get
Yeah.
what you need for now. And that evolved into a little bit of house hacking, or we traveled and rented out our house when we were gone. And then it was, short-term rentals. So we've kind of followed the trends, the BRRRR and all the things. And, the last couple of years has kind of rocked the mortgage and real estate world a little bit. So what are you seeing in today's market? And are the rates prohibitive to finding opportunities, or are real estate investors like yourself and others still on the prowl?
Definitely on the prowl, but depending on the type of asset and where. So back in 2005, when I had that show, it was a big San Francisco radio station, KSFO. So I was able to get big names, and I was able to interview Robert Kiyosaki, the author of Rich Dad, Poor Dad, which has been a game changer for a lot of people. And when he was on the show, he explained what was about to happen in the mortgage industry. And it was super obvious once I became a mortgage broker at the time, was able to give just about anybody a loan with no backup, no verification whatsoever, 100% financing or more. You could even get money back. No income, no asset loans. It was obvious that was not going to end well. So Kiyosaki was one of the few that would actually talk about it and say, this is going to blow up. It's going to blow up in the cities and the markets where prices have gone up too quickly. And those markets were Arizona, Nevada, California, the sand states, they call it Florida, um, where prices went up as much as 40% in 1 year. In 2004 and 2005, it was nuts. So the writing was on the wall. It was very clear at the time when those loans would reset. And once they would reset, people wouldn't be able to pay them. So it shouldn't have been a surprise to anybody. When he pointed out what was obvious to me, he said there's a safe place to be during all of this when this all falls out, and that would be Texas. And the reason is Texas wasn't doing those loans. It wasn't a great place to lend at the time because they weren't doing such aggressive financing. You couldn't get over 100% cash out refinance in Texas. They had gone through the S&L crisis and they weren't going to do it again. So they had stricter banking laws. So he explained, and also on top of that, they were redefining themselves in Texas because of the S&L crisis. They were offering all these tax credits to bring businesses to Texas. And obviously 20 years later, we know that worked. So with all that new business coming in and new freeways, new schools, new hospitals, new everything to keep up with job growth in Texas, the housing costs hadn't caught up yet. So it was the fastest growing market in the country by population and job growth, but housing prices were still about 27% under value if you say value is compared to how far your paycheck can go. So wages were going up, but home prices weren't, and affordability was really good. So it all just made sense. It's like something clicked in my mind. I jumped on a plane, told my husband, I'm going to go buy some property. I hope you're okay with it. I wasn't the nicest wife then. I was kind of controlling. I'm better now. But I came back with 5 properties. I could write the loans myself, and they cash flowed. They cash flowed with very little money down. I bought in a neighborhood that was again A-class schools near all this new growth. Um, and it cash flowed. So when I talked about it on my show, what I had just done, again, our phones rang off the hook with people saying, I want to do that too. So I realized, wow, there's a real need for people to have a team set up to buy, because it's scary to buy out of state. It's terrifying. If you don't know who to trust, you don't have an agent to work with, you don't have a property management company. We didn't have Yelp. This is before there were services today where you could go online and get, reviews. So it was just very, I had to meet with 10 property managers to pick one that I thought was good. And I was able to share this with my audience. And that's when our company was born, Real Wealth Network. My husband and I were like, we want to create something different, something nobody else is doing. All these real estate groups, they're just selling boot camps, people running back to the room to spend $10,000 to learn how to, flip or whatever. We want to do something different. So we were like, what could it be called? How about like the real way to build wealth and a network? So anyway, Real Wealth Network was created, and we just wanted to be a resource for people who wanted to get out of that storm that was coming. And we ended up helping thousands of people avoid complete disaster, because we showed them, like, the property you just bought that barely cash flows or is negative cash flow in California, you can sell that now at the peak while people don't know what's going on, and 1031 exchange it in Texas, 5x your cash flow, and be kind of out of the storm. So again, thousands of people listened to me, and when 2008 happened and the crash came, it didn't happen in Texas. With the properties that they sold in California, those were about 25% of their former value. Did not happen in Texas. So that was,
So fascinating. So Real Wealth Network, is that now to this day? Talk to me about the structure of the organization. Do you have real estate agents assisting with the sales of those properties back then and today? Were you also handling the mortgage financing? Is that the name of a mortgage company, or is that the umbrella education on teaching people these concepts and then outsourcing to mortgage professionals, real estate agents, and all the other people that we would call our team? Like, how has the
yeah.
Real Wealth Network evolved over the years?
Well, it always starts with education, right? And that's where I started, by accident, through this terrifying moment with my husband, who, by the way, is fine. The doctor was wrong. He is healthy today, and I am so lucky for that. And so is he, that the doctor was wrong. But at the time, it woke us both up that, wow, all these things we were doing, saving 10%, investing in index funds, doing everything our financial planner told us. When you run into a health issue, you can blow through that really quickly. And what if you can't work? You need something that can pay you while you're not working. And that was what we discovered through real estate. So yeah, it started with education, and Real Wealth is still all about education. We offer free webinars every week, and we have over 500 free webinars on our website at Real Wealth, teaching people all the ins and outs of the tax benefits, and which markets we like and why, and where we think the next opportunity is, and where we think some of the issues might be. So education first, and then second, once people understand and are educated, then it's pretty easy after that. They just want to accumulate good real estate, right? So then over the years, we have found they're not just real estate agents. Most real estate agents don't invest. Most real estate agents don't even own their own home. And many don't make very much money. I think the majority make, barely enough to survive. It's kind of a side gig. So in fact, the first couple of agents I worked with when I went to Texas had no idea what I was trying to do. And I thought, oh, how does somebody navigate this? And it turned out I needed to have an agent that either invested in real estate themselves, they have buy and hold, or I'd have to work with a property manager who really truly understood what I was trying to create, because agents can just throw out numbers like, oh, it's going to rent for this or whatever, but they're in and they're out, they get the commission, they're gone. A property manager, on the other hand, is with you for the lifetime of that property. So they're not going to lie about what the property is going to rent for. So I really created a network of expert investors, and I looked long and hard for those people, meeting with so many different companies to find them and set up these teams initially just for Rich and I, but then for other people who were interested. And again, that's what we do today.
And how has the market changes, how have they affected the geographic locations of your process? Because Texas, I would suspect, is still more affordable than California or
Yeah.
some of the other states you mentioned. However, they've certainly had their appreciation play. So are you still focused in Texas for opportunity and then other states as well? Or what are you seeing from a perspective of job
Yeah.
growth and schools and things like that?
And, surprisingly, it hasn't even changed that much. What I learned 20 years ago, if I just stuck with it, I started to follow shiny objects, and we had, some difficulties by veering from what I knew. But what I know is that if you follow the job growth, you follow population growth, and in cities that are investing in themselves, that if they're investing in themselves, there's probably going to be growth that comes with it. Then you're gonna have the people you need that would rent your place, right? So if you're going to be in a market that's losing population, that's going to be a lot harder to make the numbers work. So a lot of what was true 20 years ago is still true today, which is kind of shocking with all the changes that we've seen in the world. It's still the Southeast, still people moving to warmer climates where they're more friendly to business, where it's more landlord friendly. Not that the general population cares about that, but in general, people are moving where uh, they're not taxed to death, especially when you look at the baby boomer generation. That's still a very large generation. They are moving to places where they're not going to have to pay as much in taxes during their retirement ages. But you've also got young families doing the same, who are trying to find a better lifestyle that's more affordable. And that has been the Southeast in general. So Texas, we just finished, I syndicated a fund where we right when rates went up, I did the opposite of what everybody was doing. As soon as rates went up, I thought this is going to be an opportunity, because before that, there'd be 100 offers on one house, right? So we were kind of out of the game when it was a frenzy. And all of a sudden, when rates went up, it was like, yes, finally, it's our time. It's almost like you have to be a contrarian in real estate and not do what everybody's doing. So during the years prior to the pandemic and during the pandemic, when it was so hard to compete on a property, we didn't. We just, unless it was a great deal, it's like, we're not gonna pay too much. We've done that. I've been there in 2006, paying too much for certain properties. So we kind of sat on the sidelines. But then when rates went up, it was like, oh, it's our time. We All of a sudden, wholesalers were calling us instead of us calling them and them ignoring us. They were calling us, begging, and we're coming back saying we want a lower price and we'd get it. So we just closed out that fund, but we bought 50 homes just last year when a lot of people were scared to buy because there was literally no competition, and we got incredible deals in North Texas.
So let's talk about what that looks like for anyone listening who's not sure what we're talking about when we say syndication and funds and buying in bulk and things like that. So can you talk to us through a little bit of the process of, number one, if somebody has disposable cash and wants to invest passively through your organization versus being the person hunting down all the deals and being the negotiator and the operator? Because a lot of people do have so much on their plate, from running their own very busy businesses as well as, their personal lives and things like that, that sometimes I think people get overwhelmed by the idea of becoming a real estate investor, and specifically out of state, because it feels like you just don't even know where to begin. You're starting from scratch. How do you find a team? All that kind of stuff. So what does that process look like to invest passively with you guys?
Well, first, you do need to be accredited, and that means that you either earn $200,000 as an individual or 300,000 as a couple. That's one way to qualify as accredited. The other is to have $1 million net worth, excluding your primary residence. And the other is to have be licensed with either a, well, what is it? It's a securities license. I'd have to look it up, but those are ways that you can qualify as an accredited investor in our funds. There are some funds where you don't have to be accredited, but it's there's only a limited number of people who can do that. So that's number one. Number two is it's basically an LLC that's formed where the general partners, the GP, run everything. They do the acquisition, they do all the renovation, they manage that, the asset management, making sure it's rented. And then there's the LP, the limited partners, who just contribute money and they don't have to do anything. So but you still get the cash flows through, the tax benefits flow through, depending on how you structure it. And the GP, the general partners, get usually some fees for the asset management, usually 1% or 2% of the cash flows or the assets under management, and sometimes acquisition fees. It just depends. And then some funds will give you a preferred return, which means that before the managers get anything, the investors get their money back first, and then the profits are split after that. That's how we structured our fund. There's all different ways to structure it, so you really should have an attorney read the documents to make sure that you're in a good deal, because a lot of syndications are going bad right now, like a lot. There were brand new syndicators that jumped into the business, lots of gurus teaching how to syndicate to people who've never done a deal in their life. And unfortunately, there's a big mess out there for the exact reasons I mentioned in 2008 happened in the last year, but not in residential. So I think the biggest difference when you said comparing when I started to now is that in residential, 1 to 4 units, most people are on 30-year fixed rate mortgages. They are fixed. And most people had to qualify really, really well for those loans. Like, what it's like. You had to show every piece of documentation and prove that you qualify and that you can pay that loan back and that you have good credit. Most people who own homes today have excellent, excellent credit, because everything changed with Dodd-Frank in 2012, when it was like, we're not gonna do this again. We're not gonna have mortgage fraud anymore. We're gonna have the opposite. Like, you show us all the proof and evidence that you can qualify for this loan. So people who own 1 to 4 units and they're in conventional loans, they have high credit. They had to put down payments. They have tons of equity because values have gone up over the past decade, and they have the lowest payment to income in history. So homeowners today are in the best shape they've ever been in. Whereas if you went back to 2006, they weren't qualified, many were subprime, and they were on adjustable rates. So as soon as they didn't qualify anyway, but when the payment went up, they couldn't pay it. So very, 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 very different world. You cannot compare residential real estate today with the recession. And people get confused about that. People keep saying, I'm not going to buy till prices come down. It's like, oh, you're going to be waiting so long, because that's not going to happen. Homeowners are not in distress. That's the most important thing people need to understand. Prices don't come down unless there's distress, and homeowners are in very good shape. Now, the distress today is in the commercial world, because apartments, office buildings, some storage units, those were generally on adjustable loans. And as the payments went up, wow, people are just getting wiped out left and right. Because if you've got an adjustable rate on a $50 million building, that hurts. That hurts a lot when the interest rate was 2% and then it's suddenly 8%.
And I saw that in the communities that I participate in, run around with, or whatever, is that there was so much. I just felt like from 2020 into 2021, to me, I felt like in all asset classes, there was a lot of reckless confidence, because people were getting carried away. And like you said, attending a workshop and then deciding to do it themselves. And that's why my husband and I are so interested in finding operators like yourselves that we know and trust and have a track record and have been doing this for a long time, that we can have faith. And we also know that not every investment is going to be a slam dunk, and they don't all win. And like you said before, you kind of alluded to it, is we've also gotten, my husband and I have also gotten caught up with shiny objects. You know, we want to do all the things. It's like we want to buy and hold, and then we're going to do the Burr method, which for someone listening that doesn't know what that is, it just means buy a property that needs some work, rehab it, then you do forced appreciation by increasing the value of the property by doing the rehab, and then you can refinance to get your investment out and then rent the property, and hopefully it cash flows, and then that's the method. But you know, all the other things, house hacking and short-term rentals, long-term rentals, all the things, and they haven't all been winners, you know. So I think it's interesting what you're saying here, because as you watch what's going on between residential and commercial, do you also do syndications that buy in the commercial space, or do you strictly stay with residential because that's the asset class you love and know?
I've done some commercial, and some of it has gone great and some has been really challenged. I over the past 4 years couldn't make sense of anything, so I didn't. I passed up some really good deals because I was nervous, but you had to time it well. If you were able to sell in 2021, you made a ton of money. 2022, it might have been harder, and today it's really tough. So um, I don't, but I will once commercial real estate comes and lands somewhere. Right now, it's in free fall, in my opinion. So when it lands, I would be interested. I feel like right now in commercial, it's maybe what you would compare to 2008, where there were people saw prices come down in housing and were like, "Ooh, the property I wanted to buy is down 10%. I'm going to buy it," not knowing it's going to be down 20 or 30%, in just a matter of months. So that's where I feel like it is with commercial, is we haven't landed yet. I wouldn't want to catch a falling knife, as they say.
Awesome. So last question, because I really want to respect your time, is how do you respond if someone's listening and hears, well, you've been at this for 20 years and you've had all that time before things changed or whatever, and they feel like it's too late. I mean, I know you mentor people through this process of building their wealth. And so how do you feel when someone comes to you and feels like, well, I didn't start back then, so is it too late for me? And how do I begin?
Yeah, I hear it all the time, and then I just say, don't do it. I mean, what else are you going to say? I'm not going to talk somebody into it. You need
No,
more
totally.
education, or maybe it's just not for you. I wish you the
But
best
you're
of luck.
still finding the cash flowing deals now in the right markets.
Yeah, you'd have to look at the prices of. Here's what I would say to people. Go look online at the average home price over the last 50 years. You can type in Fred, it's the Federal Reserve of St. Louis, and you'll see a chart. So, in the 70s, we thought we'd peaked. In the 80s, we thought we'd peaked. In the 90s, you know the story, that our government is addicted to printing money. And until that changes, we're going to be living with inflation. The Federal Reserve has a target of 2% inflation every year. So unless you think that they're going to just decide that they want deflation instead, then you're going to be one of those people at age 60 that is still renting.
Awesome. I love that. Well, last question is, how can folks get a hold of you, get on your list to listen to your webinars, invest with you, connect with you? What's all the best ways for people to reach you and learn about what you guys have to offer?
Realwealth.com is where you can find me, and The Real Wealth Show is my podcast, and Real Estate News for Investors. And as you said, my book, Retire Rich with Rentals, is on Amazon.
Yes. And I highly recommend all of these things if you want to nerd out like I do on all things real estate investing, financial freedom, and just, we talk a lot about being in the room with people that remind you of your future. And I feel like the beauty of books and podcasts and the world we live in today is the opportunity to learn from and connect with people that represent the future you want for yourself. So if you're listening and you're inspired, don't be an inspiration junkie, be an action junkie. Get a hold of Kathy or follow her, or just go start consuming all the content she's putting out there, because it really is a wealth of knowledge, and it's life-changing. So I just really appreciate you, Kathy, taking the time to join us today.
Thank you.
And to all my friends out there listening, thank you as always for tuning in. If you are enjoying the content you're finding here, make sure if you haven't left a review and you've been listening for a while, you've been listening to this request, and it helps us continue to attract great guests like Kathy and get this content found, help you build that life you don't need a vacation from. I love you. I appreciate you. See you next time.